Good afternoon, everybody. It is Monday, June 7th, and it was 1,000,000,000 degrees here this weekend. It's back to a normal 80-80 here, 80 degrees and 80% humidity. So welcome from Miami, actually Milwaukee. Did you know that Milwaukee and Miami have roughly the same humidity during the summer? It's just wonderful. Our bugs aren't as big, though, because over the winter they die. All right, so let's just hit a couple of quick points. Something that I've been talking to you about for quite a while now is Jerome Powell and whether or not he'll be reappointed and what he'll do between now and January when that decision gets made. Probably he's going to stay on the same path that he's on and continue to buy bonds, 80 million a month and 80 billion a month in U.S. Treasuries and 40 billion in mortgage-backed securities. I could see him maybe backing off the mortgage-backed securities just a little bit to help cool off the housing market. But as we get towards the end of summer in a couple of months, will that even be necessary or advisable? Who knows? But I'm sure he'd like to keep the job. And for that to happen, he has to be very supportive of employment, which is President Biden's number one thing: jobs, jobs, jobs. And then over the weekend, Janet Yellen announces that zombie season will open imminently by saying that higher interest rates would be a plus for the U.S. and the Fed. Think that through for just a second. Who do you know said keep buying the bonds but raise interest rates? That's right, on my Twitter feed, in a couple of articles going all the way back to the first time we were through this 7 or 8 years ago over on Market Watch. I said, hey, keep buying the bonds but raise interest rates, not the other way around. Everybody thinks you have reduce bond buying before you raise interest rates. Says who? This is all experimental, isn't it? So why wouldn't we just keep buying the bonds but raise the interest rates first to create that normalcy, allow the market to be supported by the Fed bond buying as that happens, and then wean ourselves off the bond buying in, 10,000 or 20,000 years. All right, so that all leads us to cryptocurrency, because of course we're all going to hell from the fiat money, right? The dollar is going to collapse. It's not going to collapse. We've been through this 1,000 times. Bitcoin is tightly controlled and manipulated by a small number of persons that own most of it. They control supply like OPEC does on oil. Bitcoin is traded like a commodity, i.e. digital gold, which means high volatility. So buy the crashes, but don't chase the greater fool rallies, because there's always a big guy with a big purse that wants to cash in and undercut you. Ethereum has far more functionality than Bitcoin, is likely to be more valuable at some point. Talked about in an interview with Dr. Smith, called it the flippening. That's what he calls it. Ethereum will become more valuable than Bitcoin at some point. Why? It's got more functionality. If you are looking at the headlines and doing Google searches on Ethereum and contracts or NFTs or settlements, you'll see that the contractual nature of the Ether network allows transactions between parties much easier. And then the Ethereum serves as a bridge back to the regular monetary regime, dollars, yen, wherever you happen to be. So don't speculate on cryptocurrency or think of it in place of stocks. It's not going to be something that just appreciates forever. It'll find its equilibrium at some point, probably higher in Ethereum and maybe higher with Bitcoin if the Securities and Exchange Commission and Treasury Department allow ETFs in Bitcoin. Now, I'm against it. They haven't called me. But I think that if they do the ETFs in Bitcoin, then you will have a way for the last laundering of money out of Bitcoin and really out of China to occur, because Bitcoin was created to launder money out of China. That's who's had most of the Bitcoin. That's who started with most of the Bitcoin. That's who mines most of the Bitcoin. And the Chinese commies either are the ones doing it, or they finally got wise to it recently because they put some curbs on the mining, which theoretically would reduce supply trickling into the Bitcoin market. Been trickling for a while because of all the happenings. So if you're going to buy cryptocurrency, you're doing it on the possibility that I'm wrong, that the fiat currency, fiat goes to hell. In which case, if that happens, we'll have a depression that uses a lot of technology. Weird. Probably that won't happen. But if there are ETFs in Bitcoin, you'll see a spike. In Ethereum, because it's going to have a lot of uses, and I think that'll become the institutional cryptocurrency or the medium of exchange function of money, we can see that go higher. But it won't go up forever. At some point, there's enough of it being transacted that it finds an equilibrium, like every other financial asset ever, anywhere on the planet or the universe or unknown universes or alternative universes. That all said, I think the best play on crypto aren't actual cryptos. I think there are stocks out there that are very, very important. Why? Here's the simple version. Cryptocurrency isn't a stock or like a stock, which of course are the best investments over the long term, have always been, will always be, unless we break the system or, stop using money altogether. Cryptocurrency is more like a commodity. Who makes a lot of money in commodities? The commodity brokers. So should you own some crypto? Sure. A little single-digit percentage of your bank savings protect against potential devaluation of your currency, especially if your currency isn't a dollar. The only two cryptocurrencies I think worth having a little bit of are Bitcoin and Ethereum. And again, for completely different reasons. Bitcoin might become a store of value, particularly if they allow it in the ETFs. Ethereum, because of its unique ability to interact with that network to create contracts, to divvy up ownership of assets. NFTs, right? NFTs, non-fungible tokens, can give you a proportional share of ownership in something. For example, a Robin Yount Topps rookie card, 1975, I believe, goes for a few $1,000s. It's in mint condition. But maybe you don't want to buy the whole card. Maybe you just want a percentage ownership in that card. We can use an NFT to do that. You and 100 other people can all own 1% of the Robin Yount rookie card that's in mint condition. Honus Wagner would be better. So what companies do we want to invest in and why? Well, when the crypto dollar comes, and it will, they've already told us that it's coming. A lot of things that they tell us that we ignore because, I believe it when I see it. I remember people telling me 10 years ago solar wasn't going to have any type of a growth rate. I'll believe it when I see it. Now they see it, and they still don't believe it. They still try to sell me oil pipelines, which we're going to finish up with because I want to make fun of somebody today. So what company should we be looking at? Well, if a company is functionally able, technologically able to handle Bitcoin and Ethereum, certainly it'll be able to handle the crypto dollar. There are companies out there that can already exchange money in dollars, and they've added cryptocurrencies. Who are some of those companies? PayPal, Square are the two that come to mind. And I rode both of these early on, and then I got off the ride way too early. I should have taken my Dramamine, and I should have rode it forever. But I didn't. So now I'm tasked with trying to find another way back in. This jitterbug zone in PayPal seems to be where we're going to get an opportunity. So around $200 a share on PayPal. And remember, sentiment doesn't speak. Sentiment listens. What does sentiment listen to? It listens to liquidity. So when liquidity tightens up a little bit, excuse me. So when liquidity tightens up a little bit, stocks will come down in price. And we have to try to figure out about where that's going to get to. And remember, if it's still falling in price, if the momentum is still in force, right? If there's still downward momentum, you don't have to buy it. So while it looks like PayPal gets to here, if the market gets very angry and throws a temper tantrum because of a taper, or because interest rates go up a quarter point, or because one of those UFO reports that NASA just put out and the Pentagon just put out turns out to be non-committal on aliens, whatever the case. Remember, even though it looks like it's going to get down to here, it doesn't mean it can't get down to here. But this looks like about the equilibrium price. Doesn't mean it can't overshoot down. It's sort of a reflection of how much it overshot up. In fact, that's usually what happens. So if we can get PayPal at 130, 140, oh my gosh, we're going to buy a lot more of it. Same thing with Square. Looks like their jitterbug zone is right in here, right around 150-ish, 160-ish. But that doesn't mean that it can't come all the way down here. This is where the big support is. We're just above 100. Will it get there? I don't know. And anytime you tell people that you see something maybe coming down 30, 40%, they get skeptical. Especially, God forbid, if something has gone up for a while. Because they see this, and then this, and they think, well, it's just there's not going to be another line like that. And maybe there will be. But usually, there's a reversion to mean. Hence, the whole phrase, reversion to mean. So keep an eye on PayPal and Square, because those are probably your best investments when it comes to cryptocurrency, in particular, the crypto dollar. So I took a look at my screens this week, and there's almost nothing to buy. Almost nothing to buy. Oscillator ratings, there's only a handful that are on buys that also have an RSI below 70. But when you consider the bull-bear power, and the bull-bear power is basically a rolling time measure of does the stock have more volatility to the upside or downside when it has volatility. Most of these you can see are neutral. In other words, the volatility is about the same in both directions. As much up volatility as down volatility. Very few of these are setting up for a bullish move, essentially higher highs and higher lows. We got Viacom here. Look at that. We just invested in a stock that had this set up before, right? MP Materials did this, which I showed a triangle, which I could do here as well, and then it shot up. So not only is this an M&A candidate, but the hedge fund selling from that family office that exploded has subsided. And look at all this volume. Somebody, i.e. somebody big, is accumulating shares. I've been buying shares, but that's not all me. You need to have at least a starter position in Viacom and a sold put. And if you don't sell puts, then get yourself to about 2 or 3% in Viacom. Kohl's, weirdly, is on this list. I don't believe the hype. I got a lot of Kohl's in my neighborhood. Got the corporate office down the street. I think Kohl's is in big trouble. Big. This probably needed to happen, and this probably didn't. My honest opinion is I think I probably want to lower this all the way to here and recognize that we could get all the way back down here. I have like no reason to want to own Kohl's. Only reason it's on that scan is because it used to be a stock that I really hoped for. But when you take a look at the chart, change this to weekly. In the last 20 years, what's sexy about that? Just a range-bound stock for 2 decades. And a lower low. Crisis to crisis, a lower low. I had the bet, right? If I were a betting man, and all indications are that I am, I wouldn't own Kohl's with a 10-foot pull. So if you own Kohl's, I'm not going to tell you to sell a covered call. Just sell the stock. Just sell the stock. I don't know what their real estate value is, but that's really all it's probably worth, in my opinion. I don't think the franchise has much value, just like I don't think JCPenney has much value. If you're not a luxury brand or a niche brand, you got problems. I've been to Kohl's 3 times in the last month, so I still have the credit card, and I go in there. There's nobody there. There's nobody to help you. The inventory is low. There is nothing exciting about the way it looks, the way it feels, nothing. They better hope the Sephora really helps them for the holidays. So even here, where it says it's setting up for an up run, I wouldn't trust it. Because I don't think the fundamentals support it. And MACD there has a negative divergence. So things aren't completely lined up. So as we go down, nothing else is saying buy on the bull bear, meaning higher highs, higher lows. The ultimate oscillator, which is a nice one, is saying buy macro infrastructure. When we take a look at that, had a big pop today. I don't know that these signals are terribly reliable. I don't know enough about the company anymore, so I can't say. But I do know take an awful lot to make up this ground. So if you want something to study Macquarie, because the big resistance is more than 100% gain away. If fundamentally there's a good enough story for the technicals to drag it up. I'm not really sure that there is or there isn't. I'm just telling you, this is one of these things here where it's got my attention with these moves. I want to learn the fundamentals and truly understand the business. What could make this rally at the fundamental side? What could get investors' attention enough to make them want it? We've been through a lot of these before. Interesting, here's another rocket ship company that I put on here just to watch, right? A bunch of the SPACs, NAV site holdings. This is one that I've accumulated. I have a starter position. Look at that. That's beautiful. So you should own some NAV site. Their data collection from space, their satellite network, is very, very easy to scale because they can sell the information over and over and over again. Some of the healthcare stocks have been interesting to look at. So I have been updating the charts. Take a look at the VSL on the healthcare stocks. Some of these are just here from legacy stuff from a past life. People get excited about this one until they stretch the chart out a little bit, right? Boink, 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 boink. So what's going to happen with this one? Why do I say that? Because some numbskull put an article out this week, again, talking about Enbridge. I'm just going to make a suggestion to you. If you're investing in Enbridge, I don't think you know what you're doing. There. Enbridge is 97% fossil fuel mix. So they talk about this bridge to the energy future. They pay it lip service, but they're 54% liquids. What do we know about liquid fuels sometime in the second half of this decade? The car companies are telling you, we're not going to produce as many gasoline-powered cars. And the ones that we do produce are going to be much more efficient. Big companies like Toyota, Ford, and Volkswagen, and GM, Toyota, Ford, and Volkswagen in particular, they have hybrids. Volvo. So I'm looking at some of these hybrids because we're probably going to get something around Christmas time. So we have a second car for winter, all-wheel drive, being in Wisconsin. And the hybrids, for $1,000 or $2,000 more than a gasoline-powered vehicle, are going to get you 25 to 50% better mileage. Now that they can do that, why would they continue to produce anything other than a specialty muscle car or something in gasoline or diesel, or a really big truck that eventually become hydrogen, probably? These trends are moving so fast. When my girlfriend's lease ended in December, we said, let's hold off on getting a car. Wait till summer. And now summer has turned into, let's wait for Christmas. Why? Because the cars are changing that fast. We test drove a Venza, Toyota Venza. It's a regular old hybrid. It's extremely similar to the Lexus EZ, something. I forget what they called it. I don't know. He knows those better than me. But the Venza was such a good ride. It's so easy to look at the dash. Not as easy as the Ford Mach-E. Vertical screens are better than the horizontal from my experience, but I guess that might be a bit of a user choice sort of thing. But if we know that basically everybody has the technology now to go hybrid, and they're starting to do it, how can we possibly use more gasoline and liquid fuels if the things that we're putting them into, A, there'll be less of them, and the ones that do still use those fuels need 25 to 50% less of it. 25% of all the crude oil transported in North America. That is not a business you want to be the leader in anymore. 20% of the natural gas consumed in the US by pipes. Now, this is interesting, right? Because these pipes can be turned into hydrogen, right? Same argument as Kinder Morgan. But Kinder Morgan is like 90% this, and they're only 20% this. We know that next decade, natural gas volumes will start to fall as well as the utilities start moving to alternative energy, actually continue the trend. And these guys have a whopping 3.6 gigawatts of solar power and other alternatives, whopping 3%. I want to make an analogy about some of these oil-related companies. You know that girlfriend or boyfriend you broke up with, and they just keep calling back like month after month, year after year. Hey, you know, we can still be friends, right? Want to go out for a drink? Maybe a coffee? Huh? That's what the oil industry is becoming. The jilted boyfriend or girlfriend is like, oh, but we can still be friends, right? Let's just go grab a cup of coffee and talk. If you own Enbridge, sell it on this rip. Because again, these guys, the most popular car in America is now electric. Think that through. Most powerful car in America is now electric.
F-150 Lightning will be the smartest, cleanest F-150 ever.
Smartest, cleanest F-150 ever. And I had another video that you can find on YouTube. I'll list it somewhere, where a guy was on the street in Phoenix, mostly Scottsdale. I think he hit Tempe and Gilbert as well. Had a Tesla Model Y and a Ford Mach-E right next to each other. And 2/3 of the people said, I really like that Mach-E better than I like the Tesla Model Y. I've seen them together as well. The Mach-E is a way better looking car, in my opinion. Unless you have a Jones for Tesla, I don't know how you could say that Tesla is a better looking car. But what we know about performance is that they're darn close, and this is Ford's first try. Tesla's been doing this for a while. Ford's going to double yet. And might triple. So Ford is a buy the dip stock. So you get it back down around 13, the 13 handle. Show you something here. See how it hit right there? Came back down to there. Fib to fib, gets through. Now, I think it's going to hold in the 13s. Got the tech guy, that a technical analyst I'm talking to, is saying maybe all the way down to 12. So it might actually come back and hit this line again. I think he referenced the 236. Our lines probably don't match up perfect, but they're pretty close. So a 13 handle down to an 11 handle or a 12 handle. Somewhere in there, you want Ford. Sell the puts. You already own the stock. If you don't own the stock, figure out a way to get some up here, and if you have to buy again here, and frankly, honestly, learn how to sell puts. What else? Zoo, right? Buy it, right? The European Carvana, buy it. Nav site, buy it. The other company that you want to take a look at that's just like Nav site, Osprey Technology, right? Buy it. I mean, if you've ever thought of yourself as a value investor, I mean, I don't know what these charts say to you, but they say, oh my God, look how cheap that is, and it's not going lower. Not going lower, not a lot of risk. Yeah, I might go back up here. Probably will. Just take some time. So Osprey Technology, Nav site, Ajax. There's so much hate thrown on these SPACs Now that they've already announced their deals, you can just analyze the deals, see what's going on. Between now and autumn, you want to work your way to full positions. Now, it doesn't mean these can't go down a buck or two because of, liquidity might be changing. I really think that you do well for yourself being a put seller. So let's transition to retirement income options. So stocks of the week is over. For those of you stick around for about 30 seconds, we'll start talking options.